Hey everyone, my name is Mikas. I'm the lead analyst here at Onward BTC, and today we're going to be doing one of our higher time frame analysis videos, but we're going to be taking a little bit bigger of a step back than we normally do, and that's going to be for a very specific reason. We're going to be trying to tie in, um, data and behaviors from the previous two bull markets that Bitcoin has had, and tie it in with the concepts of Elliot wave and Fibonacci. And this video is going to be a little bit different from the other analytical videos that we've done, because in this video I'll try to teach you the methods of using Elliott wave specifically in combination with Fibonacci, or at least give you the surface level, because the relationship between those two does stem pretty deep and can be learned to a whole different degree, advanced level, like many of these concepts can. So I'll just be giving you the tip of the iceberg, or just kind of the general relationship between the two, to see if that's something that interests you, and to see how that fits into kind of what I'm looking for in terms of a pullback. If bears are going to be stronger than bulls here, what are some of those major levels that we should be keeping our eyes on, and what is the general target of this bull run. Actually, we'll take a look at that too. Just trying to get a better idea of where we might be at this point in this, bullish market cycle. So before we get into the analysis on TradingView, we're going to go through a couple slides just to freshen up on some background knowledge, which will be key to understand and use to follow along as I do the analysis. So let's get started. As I already mentioned, there's going to be two main theories that we're going to be using today, one of which is going to be Elliott wave theory, and the other one is Fibonacci. We'll start with Elliott wave theory, and this deserves a whole video on its own because there are many levels to it, but if I had to give you kind of a one-slide summary, this is what it would be. What is Elliott wave theory? It's essentially a theory that is based on crowd psychology, and kind of how does that affect, and how crowd psychology impacts price action into this kind of, it forms a natural, like almost rhythm that price action has, that happens over and over again, and it's a pattern essentially. And this is a pattern of price action, which moves, alternating between trending moves, which are impulsive, and then corrective moves, which are against the trend, or the greater trend. We'll get into this in a second here. So what are some of the pros and cons? It's useful for kind of getting an idea of overall market cycles and where we could be on the higher time frames, just because on the higher time frames, if you take a step back and you use these tools through almost like a psychological lens, you see that these things will play over and over and over again, especially on the higher time frames, because unfortunately retail traders are the number one part of this market which suffers. 99% of retail traders unfortunately don't make it past 3 years. So you see these psychological moves playing over and over and over again, and that's where Elliott wave kind of comes into play. So it's useful for getting like a general idea of where you might be in this market cycle. I think it's a little bit more tradable in traditional markets than it is in crypto, and that has to do to crypto's volatility. Sometimes it gets a little messy, and there are certain rules that come along with Elliott wave, and this is kind of where you can get into a spectrum of Elliott wave theory use. There's some people that are very strict with the rules, and they need all the rules to be met in order for something to be counted as the first wave, the second wave, whatever. Whereas I'm a little bit less strict with the rules. I usually fit general market directions and phases into these waves, and that's how I used to count. We'll get into it in a little bit. However, it can get complicated very fast just because it's generation based, which means that you can kind of see it over here that within each wave there's going to be sub waves, and then this entire leg is the first wave of the generation above. So it can get really kind of complicated, but in general, Elliott wave theory states that the market moves in sequences of 5 impulsive waves followed by a three-wave corrective move, and then Fibonacci comes in next. How do we measure where the first and the second, where all these wave counts might fall? In general, just the rules about Elliott wave theory is that the second wave can't retrace past the entire first wave. It can't go down below here. The fourth wave should not, right here actually. Wave 2 should never go below wave 1. Wave 3 is never the shortest wave. So that this can be it can be longer or shorter than one of the other waves, but it can never be the shortest wave. And then wave 4 should never overlap with wave 1. And this is where that's a relatively strict rule in crypto. You do see at least wicks or dips into the first wave. Past that, not so many rules for the ABC, but there are, but you would have to look into the corrective wave section on Elliott wave theory more specifically to get a better idea about that. But that's pretty much the general idea. Just keep this in mind that we have 5-wave impulsive moves in the direction of the greater trend, followed by 3-wave corrective moves in the opposite direction of the general trend. And then I'll go over the Fibonacci here. So Fibonacci retracement and extensions. This is going to be a very basic tool that every trader should at least understand and know how to use. It's a simple kind of retracement tool. So you just you pick a swing low and a swing high, and then you're going to draw your retracement from the swing low to the swing high to kind of measure how far back is the next wave going to pull. And then the kind of ratios of interest are always going to be the 0.618. That's kind of like the golden ratio. The 0.382 is a secondary, or the second most important level, in my opinion, to keep track of. And then past that, we have the 0.236, the 0.5, and the 0.786, each special for their own reasons. The 0.5 is literally the midpoint. The 0.236 is going to be the shallowest Fibonacci sequence number. This can be a strong support if the trend is really strong. So in like a parabolic bull market, you'll see that usually only the 0.236 is tested before continuation. And then on the other hand, the 0.786 is a very common squeeze level to sweep liquidity. Most people are keeping their eye on this 0.618, and they put in their entire buy-in for here. So whales kind of like to try and generate a little bit of fear in the market by squeezing down to the 0.786, and you'd be surprised how many people actually either panic and get out of their position or set their stop loss somewhere above the 0.786. And then that was, I mentioned the retracement tool. The extension tool is very similar. You draw it in the same sort of way from the swing low to the swing high, and then you simply measure the pullback, and that's going to be your third click in using that tool. With that, the same levels, apply. The 61.8%, 38.2% are going to be very important. The 0.5 is also important, but most importantly, the 100% level is also a very key level. And then past that, you can also go to exponential targets, so you can get a 161.8, a 138.2, and so on. And those, you see those in parabolic markets and sometimes with the third wave, as we will get into right now. So, as we just mentioned, retracements and extensions can be used as a tool to try and predict how far a pullback will happen. That's specifically a retracement. And an extension can be used to try and project a target or how far the next trending move might go. So naturally, when you have a like a structural theory such as Elliott wave theory and 5-wave impulses followed by 3-wave pullbacks, naturally there's going to be some kind of overlap between this retracement and extension prediction tool. So there's a lot of theory about this, and this is one of the more complicated trading strategies. Is the Elliott wave and Fibonacci synergy, and I'm going to give you the very basics. There's many different scenarios. There's all these values change if the first wave is the longest, or if the fifth wave is the longest. But remember, the third wave can never be the shortest. So there's different retracement and extension values depending on the length of each of these impulsive waves to the upside. The second and the fourth wave don't vary too much. And then past that, this correction sequence, the ABC, the corrective move, there's 3 categories of scenarios. There's going to be zigzags, flats, and triangles. We're relatively, as a beginner trader, you probably see a lot of triangles and you learn about a lot of triangles, but Fibonacci and Elliott can be even applied to that, as you see me sometimes doing wave counting within triangles Similarly, flats and zigzags are other and less noticeable, but still common configurations or patterns of corrective moves. And those also have their own relationship with Fibonacci to try and predict the retracement and the pullback and the target levels. Right here, I've just included kind of the most common is going to be the zigzag, especially if you have ever used the three-wave corrective tool in TradingView. It's an ABC wave, and this is exactly where it comes from. You have the A, B, and C. You can also have the W, X, Y, X, and Z, or a three-wave, W, X, Y, and so on. So, and there's, these are the three categories. So, yeah, I think that's pretty much it. So, going over it really quick, you can't really predict the first wave because it's the first wave of the sequence. We have no data. Off of the height of the first wave, we can use a retracement to try and predict how far the second wave will pull back. This usually pulls back further. So the 50.5 to 0.618 retracement area is usually that golden pocket for a second wave pullback. Trying to predict where the third wave is going to fall. We're going to measure the first wave and then draw our extension tool back to the bottom of the second wave. And wave 3, from our most basic rule, is never the shortest, so we're going to assume it's the longest. And we're going to actually be targeting the exponential 161.8% extension. In parabolic markets, I guess it can be the 200 as well. I always like to target, for the third wave, I keep the 61.8, the 100%, and the 161.8%. Just because you can get a lot of variance with the third wave, just because it is kind of the trickiest. The fourth wave pullback, we measure a retracement from the second to the third wave, usually a little bit shallower as there is bullish momentum now in price action so far. So usually that 38.2 to the 50%. I like to say the 38.2. However, sometimes you do see a pullback to the 61.8% as well. Fifth wave extension targets, from the second to the third back to the fourth. Usually I'm going to say the 100%. This says this 161.8, but I usually once again have the 61.8, the 100, and the 161.8 for all of these extension targets. And then, we'll get a shift in market structure. We'll be starting to put in a lower high, and then between that there's going to be a low as well, and then this will kind of dictate how big of a corrective move you might have. If you're below the fourth wave, I would expect a little bit more bearish momentum just because you have set a macro lower low. However, if it's above that, somewhere above the 100, because if you're measuring this retracement here, so if it goes below to like the 161 or anywhere below this fourth wave swing low, more bearish I would expect. Maybe targeting the 161.8% extension on the C wave or something like that. But this is relatively hard to predict. You got to let the A wave fall wherever it does, and then based off of this, you can kind of predict the B wave. This is ideally the best place to short a market if you're looking to, since the C wave is usually the longest corrective wave. And similarly, as with the third wave, we can usually target the 100 or the 161.8% extension. And then you'll notice, within these more complicated schematics, even within these three-wave corrective ABC moves, you'll have a five-wave impulsive structure followed by a three-wave drift in, the counter trend direction, followed by another impulsive move, pushing that, C wave and A wave. So yeah, that pretty much really quickly goes over the relationship between Elliot wave and Fibonacci. There's a lot here, and I recommend looking into it deeper, especially if you're interested in this kind of wave counting and more so trying to fit market psychology to price action and technical analysis. This is a really good theory for that overlap. It is not the best theory. It is not the only theory. There's also Wyckoff, which I really recommend, but it is something that is very useful to understand. So definitely don't put all your eggs in this basket, but it is a useful tool, and I recommend for the more intermediate traders to kind of look into this, as this could push you towards that more advanced side of things. Yeah, this is going to be generally, I'm not going to go over this, but correction-wise, there's a lot of different types of corrections. You're probably used to really seeing these triangles or wedges. They also come in combinations. This is why things get complicated. Because you can have a zigzag like this, which usually appears as a bull flag, or a bear flag if it's in a downtrend. But you can also get combinations. You can go from a flat to any three into a zigzag, and that'll complete that corrective wave. So it's kind of hard to predict. Not one of these patterns isn't guaranteed to kind of decide that local bottom or whatever. So you can't just kind of rely on only one of these patterns to fit every narrative. But without further ado, let's get into TradingView and kind of apply some of these theories. So we're going to hop into the Bitstamp chart actually, just because it does have the most history on TradingView. And before even doing any wave counting or fitting any Fibonacci to the chart, what do we notice? We notice one parabolic leg, maybe not parabolic, I'll call this a bull market. We have one bull run, two bull run, three bull run, right? So what does that already tell us without fitting anything? If we're just drawing our 5 wave count and really like just putting it on the chart to fit it now, what do we notice? One bull run, two bull runs, 5 bull runs. So there is now 3 impulsive macro upside movements, which kind of coincide with 3 impulsive waves, which is where a lot of bearishness is now coming. Because this looks very toppy from the weekly from a high time frame. Like we didn't even get that dragged out of the top here, or really here. So a lot of some advanced traders are kind of calling for a multi-year bear market, because since we've completed this Bitcoin's first complete impulsive cycle, we should be expecting a 3-wave corrective move. Which means, if this is Bitcoin's entire history, timing's very hard to predict, but this could easily be a 2 or 3 year bear market, into 24 or something like that. So this is where that narrative is coming from. And what we're going to try and do throughout this analysis is essentially suss out if this is true. Is this the end to Bitcoin, Not clickbait, by the way. Anyway. So we're going to get started. We're going to be using the retracement and extension tool and just literally applying those guidelines that we just went over in the PowerPoint. So with the first wave, I'm actually going to pull it from this wick down here, and I'll tell you why in a second here. And that is going to be because, out of all honesty, Bitcoin back here in 2012, not very popular. I mean, it definitely had a little bit of a bull run, but we didn't really see any volume expansion. Obviously it was slow, but we only started to see a volatile expansion in volume right after this wick happened. This is because not only was Bitcoin listed on quite a few more exchanges in that 2012 to 2013 period, but also this is where we just saw more money flowing into the space. So this is kind of where I call Bitcoin's official beginnings, because this is where we kind of set a baseline volume that's relevant until today, this kind of area right here. So that's why I'm calling that. Anyway, what did we say about the second wave? We said that it is usually a little bit further of a pullback. So we're going to be looking for that 0.618 to that 0.5 to 0.618. And what do we see here on a wick basis? We perfectly test the 0.618. So I'm going to fit my second wave right to there. And as we go, you'll notice that the second wave and the fourth wave are counter trend moves, so in the opposite direction of the trend, and this is usually where you see those longer periods of consolidation. So back here, a lot of people were drawing trend lines, they were trying to figure out what kind of a pattern do we have here, and this is usually when you see those patterns, is during the second wave and the fourth wave, since they're periods of consolidation. So what did we have here? Now, you could fit this in a lot of different ways, but I mean, it's not very nice at all, but kind of a descending wedge, right? So bullish in nature, and it did play out bullish after a perfect retest right here. So now, based off of this data, we're trying to figure out, what would our targets have been for the third wave. We're going to use the extension tool exactly from the same place where we pulled the retracement through the top of the first wave and back down to this test of the 0.618. And we're going to be looking for those exponential targets, because we said that the third wave is usually the longest, not the shortest, and that's why, sorry, 1.5 is what I need, 150, perfect. So what do we notice? We do not actually test the 161.8% extension on the third wave. We do come close. We almost hit the 150, but this is why having those other extension zones are quite important, because I think what we'll see here is if we make this the exponential 138, is we entered that kind of magical zone, right? Yeah, so we did test the one, we did go into that ratio or that zone between the 38.2 and the 61.8%. So that's why, keeping all of these levels up and not only sticking to one level is important, because once you see a sign of reversal in this exponential zone, that's going to generate quite a bit of bearish pressure. So, not perfect, but, still hit that exponential zone. And that's kind of what's important, is it went 1 degree higher than, many of the other targets. Let's get rid of that for now. We're trying to measure this fourth wave pullback. So, exactly where that wave 2 low was all the way through the wave 3 high. I'll pull this over manually instead of using the magnet. And we said that the wave 4 pullback is usually a little bit less, right? And what do we notice here? We got a perfect test of the 0.382 back here. That was retrospective after we put in the high. And we almost tested it, or we barely tested it. So that's why, exactly, these levels are general guidelines, especially due to the volatility in crypto, that they're super hard to predict, but we can see that it worked, pretty well. So following the same guidelines, now we're trying to predict where the fifth wave is going to fall. And this is going to start kind of shaping up analysis for more relevant or more timely analysis. So I go from wave 2 low, wave 3 high to the maximum pullback point, and we're going to say that wave 5 is usually going to be a little bit shallower than wave 3. So we're not really eyeing those exponential targets. We're more interested about the 61.8, the 100%, mostly interested in the 100%. So officially, my target, my bull market target, is going to be right around 402,000, 904. And before we kind of get into the more, actually no, we should do that first. So what do we notice? We noticed that we tested the 61.8% target perfectly, and now we're getting a little bit of a bearish rejection off of that. What does that kind of insinuate, or at least what does that tell me? Well, the 61.8% is still a very strong level. It is still, part of that golden ratio retrace, or it's still a golden ratio value. Therefore, a lot of players will be taking profit, especially in all-time high territory on that third kind of impulsive move to the upside. People are going to try and secure profit, especially after a huge, markup from 3K to, 63K. That's insane. So people, in my opinion, are locking up profit here. They're cashing out. I don't think that necessarily means that this is, that pivotal moment where we're entering a bear market. I still do think that due to, also fundamental reasons, that Bitcoin does have some more upside potential before we enter this extended three-wave corrective move, potentially, probably a multi-year bear market. So the one thing I wanted to mention is some people critique me on this analysis that, the third wave can never be the shortest, and it certainly looks that way because, this line looks longer than that line. But if we actually pull out the percent tool, we notice that, this, and this, if you measure it from here, it's really not the shortest wave. But, if we're playing by the strictest rules from all the way down here, that's, 52,000% bull market. That's crazy. I mean, for anyone, that's a huge percent value. Up here we have a, 13,000, and then if we measure from, sorry, I just lost this tool. Yeah, right here. From here, kind of to, here to the 100%. It's close. This is, 13,000%, and this is 12,850. So, still technically shorter than the third wave. So it is, not the longest. The first wave is the longest, but it is the second longest. And I just wanted to get that out of the way before we get into some subwave structure. So now, what's a secondary point of kind of confluence to trying to say that this is not the ultimate pivot point, because if there's a shallow retracement, it could pivot here at the 61.8%. But as we said in the PowerPoint, there's going to be subwave structures here. So we're going to quickly draw in, a three-wave subwave structure. And what do we notice? It looks like we're working on the third wave, and we're now rejecting off of the third wave because this is what initiated that fourth to fifth wave. So, 1, 2, we didn't get more than, you could fit retracement to here, but from doing this previously, I can tell you it goes down to 0.618 and the 0.786. But it doesn't retrace more than the first wave, so it's still valid. In terms, we can plot in the targets really quick for this one, and we can see that we go past those exponential targets, and then we complete the third wave, and now we're working on the pullback on that fourth wave, which ultimately, is usually a little bit shallower of a pullback. And this is where kind of that hard floor comes in around 22K. 20 to 22K is where I think ultimately this kind of profit-taking and bearish momentum will land, just because structurally that would be a really nice test of the previous all-time highs in that 2017 region, and then it would also be a nice test of the 22K region, and then ultimately still targeting these macro retracements. But once we complete this fourth wave, it'll become more clear, and we'll be able to measure a secondary extension target to get more confluence as to where that fifth wave might fall. We're still working on that first downside move. We can, if we hop down onto the lower time frames, we're putting in a little bit of like a bearish, here it better looks on this chart. We're putting in a little bit of a bearish channel, some bullish divergence, but we'll see if it's enough. I definitely think there is a little bit more downside potential before we get reversal. And I will be putting in long time buy buy orders at that 22K region, and I will manage and update you in the long-term signal chat as well. But that essentially does it for this high time frame analysis video, and hopefully by combining a little bit of educational content, this actually helped you A, keep along, and B, learn a new skill. But that essentially does it for me. Let me know if this helped you, and I'll see you guys in the next one. Thank you.